lithium has matured. Conventional Western private equity players are coming into the space.
This assumption that as soon as the war's over, production will restart straight away is a very flawed assumption.
We are looking like a stagflationary environment rearing its head again.
We also announced just a slight delay to our MRE. It's only delayed for a few weeks.
Welcome back to Rockstock Recap. It is Thursday, March 26th, and day 27 of the Iran war, which continues to overshadow corporate and commodity-specific news, but has not stopped some important deal-making in the lithium space we'll discuss in a few minutes. Matt's had 3 pretty viral tweets over the past 10 days as he assesses the broad cross-currents resulting from events in the Middle East. First, he focused on sulfur as a completely underappreciated bottleneck, given roughly 45% of seaborne supply moves through Hormuz and its critical role across fertilizers, lithium chemicals, uranium, and rare earths, meaning even modest disruption could ripple across multiple supply chains. Second, he made the point that commodity supply doesn't just switch back on when conflicts end. Whether it's LNG, aluminum, petrochemicals, restart timelines can take weeks to months, and that lag is not being priced in by markets. And third, on gold, he highlighted that the lack of price response to geopolitical risk is likely technical rather than fundamental. Profit-taking, rotation to higher beta commodities, and deleveraging, while the broader inflationary backdrop remains intact. Taken together, the message is pretty clear. Cost pressures and supply disruptions across commodities are being underappreciated right now. On the deal-making front, notable is that Core Lithium got fully funded and moved to final investment decision for their Finniss project in Australia. Then, in Brazil, Lithium-ion signed an offtake with former Core offtake partner Yawa, with the same $1,000 price floor that PLS received from Canmex. Importantly, with no ceiling, and also a prepayment. These are 2 quite different structures and partners, but both point to the same thing, that projects, in particular spodumene projects, are getting financed again. While lithium prices have remained strong, it remains the case that most of the margin remains at the upstream spodumene level rather than at the converter level. With no resolution yet to the Zimbabwe export ban, and no sign of restart of Chinese lepidolite mines, there remains strong interest from both Chinese and Western players for existing and near-term spodumene supply, which provides a great backdrop for Atlantic Lithium to advance its partnering and full funding now that it has finally received parliamentary approval for its project in Ghana. Brazil and Africa are 2 very important jurisdictions that have received less love on the RK equity scoreboard in recent quarters. Core's valuation is 2 to 4 times higher than Lithium-ion and Atlantic, which could present a near-term re-rating opportunity, in my opinion, as these projects move from the orphan period in the Lassonde curve on the road to becoming producers. Separately, Sigma Lithium continues to be highly volatile and underappreciated, but there are positive signs from their frequent postings on LinkedIn and X showing construction progress as they restart under an owner-operator model. I'm looking forward to Sigma's year-end earnings results next week for an update, the last company to report this earnings season. The second last company to report this earnings season was Lithium Argentina, which reported this week guiding further cost reductions to $5.4 a kilogram operating cost and notably much higher Q1 pricing to be $17 a kilogram, up 88% from Q4's $9 a kilogram. Regular viewers and listeners of this channel may recall that Matt flagged both SGML and LAR at the bottom of the market last summer as 2 low-cost producers trading at low valuations. Both look attractive, in my opinion, for those looking for Iran war dips to buy. Which, of course, is just my opinion and not financial advice, nor is anything else you will hear in this discussion today. Please read the disclaimer at the end of this video. And before we dig in with Matt and Rodney, we'd like to flag that we just launched RK Equity's new website. So please check it out and also register your email to receive the Lithium-ion Bull and summaries of Matt's blog directly to your email box. And please stay tuned. At the end of this video, we'll have a quick update with Q2 Metals' Alicia Milne and Neil McCallum following a press release earlier this week. And finally, thank you to our sponsors, USCF Investments, who have been making it easier to get exposure to commodity investments for almost 20 years. Their battery metal strategy fund, ZSB, is designed to capture investment exposure to metals powering electrification such as lithium, cobalt, copper, nickel, aluminum, and silver. And Lithium Royalty Corp, which was acquired by Altius Minerals earlier this month. Altius is a 2 billion Canadian diversified royalty company with producing and development stage royalties across copper, potash, iron ore, renewable electricity, and some gold assets as well. And with that, Matt, Rodney, nice to see you again. We missed the Rockstock recap last week, but put out a whole bunch of other videos. So we have 2 months of recap to kind of catch up. So Matt, why don't we start, maybe you could augment a little bit, those 3 very significant tweets, or at least very popular tweets, unusually popular outside of the lithium space.
Who wants to read that rubbish? God. I think the first one that's the most important for me is on sulfur. I think a lot of people sort of look at sulfur and go a bit dull, boring, unexciting. Can't deny it is all of those things, but where it is really important is as a core industrial commodity. So, you look pretty much anywhere across the manufacturing spectrum, and sulfuric acid is somewhere in the value chain. And in a lot of value chains that are important to this sector as well. So, for instance, copper SXEW production, nickel and cobalt HPAL production. It's in the LFP value chain for the manufacture of phosphoric acid. It's in the lithium value chain for the manufacture of lithium hydroxide. So really, most of the places you look across the metals and mining value chain, sulfuric acid is there. And it's there in a lot of chemicals products as well. So this fact that something like 40% of global sulfur exports, that's sulfur exports, by the way, not sulfur demand, but sulfur exports come from the Gulf, is very, very important. And a lot of countries, particularly the Asian countries, China, Japan, Korea, they're very, very dependent on sulfuric acid made from exports of sulfur from the Gulf. And I think that people don't quite understand how significant sulfuric acid is as an industrial input. So that's the first one. And the next, slightly less important, but still very important one, is the posting about duration, really. I've heard a lot of people refer to it as duration, which is this feeling in the market that as soon as the war ends, this oil and gas production will just switch back on again and everything will be fine. And of course it won't. I mean, as we've heard in the news, the damage to the Ras Laffan LNG production hub, that could take 5 years to fix. These LNG production facilities, I was reading the other day, there's only 5 companies in the world that make this LNG production equipment. They're all maxed out for capacity. It's going to be very, very difficult to fix this equipment. The oil and gas infrastructure that's been damaged, when you switch off an oil field, you can't just switch it back on again. It takes a long time to repressurize, to check that all of the equipment is working. So this assumption that as soon as the war's over, we're just going to click our fingers and production will restart straight away is a very, very flawed assumption. And it could take probably between 3 and 9, maybe as many as 12 months before oil and gas exports restart, and to the same level they are at, and it could take 3 to 5 years before LNG exports restart to the same level they're at. So I think people are not really factoring that in their assumptions, in their economic assumptions, in their impact assumptions as yet. So for me, those are the most important sort of takeaways from what I wrote.
Matt, there's obviously the issue around fertilizer and a number of things. So all of this, to my mind, points towards inflation and stubborn inflation for the next while. I can't see how. I saw the latest forecasts. I can't remember which agency, forecasting about 4% for the US and then dropping down next year, but that feels like that's too quick for me.
Yeah, I mean that feels unlikely to me as well. I mean, I didn't touch on fertilizer as an impact, but obviously sulfur is used to produce phosphate fertilizer, and then nitrogen is sourced from gas, which comes again from the exports from the Gulf. So you've got 2 of the 3 key fertilizer inputs are going to be impacted by what's happening in the Gulf. And things like corn, wheat, sugar, they're all very intensive. So and then on top of that, you've got livestock, which is grain and cereal intensive. So if grain and cereal prices go up, if crop prices go up, livestock prices are going to go up as well, and that is going to pass through over the next sort of 12 to 18 months to the consumer.
I agree. So I guess if you look at it from that perspective, and inflation picking up and AI playing Pac-Man with white-collar jobs, amongst just general efficiencies, we are looking like a stagflationary environment rearing its head again, which then raises the question of what you mentioned about gold. Fundamentally, this is the 70s we're possibly staring at again, because we don't know. I mean, we'll wait to see an outcome, but if there's a sort of, how do I put it, is sort of a Mexican standoff or something that isn't permanent, then the Strait of Hormuz and oil supply and everything is going to be at risk for some period of time. And it's a lot of investment to ask people to go back in at risk in that region. So your thoughts around, about gold, I feel like UBS and the other forecasts of around 6,000 for year end are good.
I don't know what I can say on gold. Not a specialist on gold, but from the outside looking in, I agree with you. It's everything that I see points to a major inflationary environment. And the other thing, obviously, to be aware of that is getting very macro for this conversation, but obviously is the replacement of the dollar as a reserve currency with the renminbi, which only looks as though it's accelerating through this emergency. And what does that do to the strength of the dollar? On top of that, you've got all of these Gulf countries, which are big holders of US dollar instruments. Are they going to have to dump those US dollar instruments in order to fund themselves because they can't rely on oil and gas? There's all sorts of elements out there that could result in a weaker dollar. So weaker dollar, high inflation, pretty positive for gold, I would say.
I agree.
Sitting here in America, I'll be a bit more optimistic view on the world, and also take some cues from what is Mr. Market saying, right? Gold has sold off a lot. I just listened to a podcast that was saying kind of like bonds are the new gold. With Venezuela kind of taken care of, I think like they were buying oil in renminbi, so and then they were buying Chinese goods, I think, with that. So I'm not so bearish that the trajectories we saw, before the Iran war, with all of those things on a big macro point will actually happen. We'll see. The market's looking forward. I remain optimistic. She and Trump will eventually get together. I have a good old hedge fund friend who I communicated, who wrote a piece called "Deal of the Century," which we could flag up here. We hope to have him on the podcast in the not too distant future. I've been talking about for a while, grand bargain, potentially on the battery supply chain, welcoming Chinese FDI into America. He's talking about something, much more substantive, including that as he looks at, broad, geopolitics. And the markets do seem, the broader markets, oil's under $100. I know we have this 5-day reprieve, with Trump. It's really hard to understand, what's happening. There's a lot of misinformation. They're negotiating. The Iranians are saying they're not negotiating. It's really hard to figure that out. But the markets are telling us, right, there hasn't been this major calamity. Oil's not at $150.
But that's the point I'm making, Howard, that the market is underestimating the duration of this. And also, I don't want to use the M manipulation word, but it does seem increasingly likely that there's a lot of, how should we say, government-sponsored shorting going on in the oil market, which potentially could be keeping oil prices below where they are. Physical oil prices are something like 30 to 50% above paper oil prices at this moment in time. And I don't think we've ever seen that sort of disconnect.
Look, the one thing I'd say, Howard, is in my 56 business years on this planet, I've never seen oil stay for a reasonable period of time at $100 or more when there not been a global recession.
Okay,
so
but
it needs to resolve itself.
Yeah. Is $100 today the same as $100, 10 years ago, given, all the inflation?
I would say
the
fragility in the consumer is worse than the past. So you can inflation adjust it, but personal balance sheets are in a much more fragile state than they were historically. If you look at cost of housing, if you look at cost of living, etc., the give and the savings rate is just not there. So I would say $100 is still enough to cause a major problem. Cheap oil is ultimately important for a number of key economies. And let's be honest, the striving for net zero has made quite a few of the Western economies completely uncompetitive against China. So, Matt?
I think that there's another important thing here. We talk about oil, but really we should be talking about downstream oil products, things like gasoline, diesel, heating oil and everything. Just in Europe at the moment, heating oil prices have gone up by sort of 40, 50, 60%. Gasoline prices going up. A lot of countries are net short in terms of oil products. I was reading something today that a number of forecourts in Australia have actually run out of oil products. They're rationing oil products in some countries in Asia. Reserves are down to less than a month in some countries. So it's not just crude oil, it's also downstream oil products, which are a really important product from the Gulf. And of course, it's the downstream oil products that's going to fuel inflation at the consumer level.
Okay. We'll see how things play out. I've just, however smart you are, Matt and Rodney, I love you guys and are brilliant. You guys are two actors and analyzers in the market, and then the market collectively, especially liquid markets like oil, not illiquid ones like lithium equities, do contain a lot of information, in them. And I think even the forward curves for oil are not, screaming, calamity. But maybe you're right. Maybe the government is manipulating to some degree, and they do intervene in highly liquid currency markets from time to time and have temporary impacts, and that could be, taking place. as we speak. I want to pick up on a point you made, Rodney, about energy transition in Europe not being competitive. There was an article yesterday in the Wall Street Journal with CATL's Robin Zhang basically saying, America, and Europe, I think he said America, but I think it also applies to Europe. You're going to need us, right? You're just like not going to be able to make batteries so cheap. And I think he's like the 5th richest guy in China. And he recently had some conversations with Xi Jinping. So he's like an Elon Musk, Jeff Bezos, Jensen Huang like figure, in China. And I'm sure he wants to strut his stuff on, the American stage. And, to be seen. Look, there was a resolution on the TikTok, but still the Chinese retained some, ownership there. And my teenage son, who is on TikTok's, data is somehow getting into China. And so if that's allowed, why wouldn't batteries, be okay, made by Chinese, in America? So,
but to some extent, Howard, what there's still a missing piece in the pie, which is downstream demand. So there's no point in the Chinese cell makers investing in the US if the government's not stimulating downstream demand. So I mean, much applause to this government for stimulating the upstream. First government in probably the whole of my career to focus on the upstream, and as a mining guy, I love that. But there's still a missing piece in the jigsaw puzzle, which is downstream demand. And the Biden administration was very positive on downstream. The Trump administration has been positive on upstream. But to stimulate investment in cell manufacturing and in fact in upstream, there needs to be a downstream market in the United States.
And there is one developing in AI. So as we had Iola Hughes articulate, so ESS is the new EV. At the same time, though, looking beyond the Iran war, this is net positive toward, if you're right about oil prices going up, the affordability of EVs, even without the government stimulus that you're asking for, is a moot point, right? So if CATL batteries can make manufactured in America, can make EVs more affordable than ICE vehicles, then people will buy them. And on this point as well, I'll say, I also listen to a podcast like the Tesla Semi is gearing up for major production, right? This is like 50,000 vehicles in America. I listened to a podcast which was talking about, a very MAGA guy, right? Truck driver, super excited about how much easier it is to drive, how the less noise, less pollution. It's less taxing on the body to drive a Tesla Semi than a regular Tesla truck. So if you suddenly start seeing truck drivers loving electric trucks, right? The transition to the truck driver who is just like, I got to drive my F-150, ICE vehicle, and I'm not going to drive some sissy electric vehicle. That mentality is going to change, in my opinion. So I'm for welcoming Chinese foreign direct investment into the U.S. across the upstream battery supply chain, including chemicals, lithium chemicals, anodes, cathodes, the whole lot. And I continue to believe that, there is some grand bargain in store with Trump, and that a second order effect of his, what he did in Venezuela and also Iran is to enhance our negotiating position vis-a-vis China. And with that, I'll transition actually now to a China versus ex-China in the lithium space, because we had Core Lithium, who used to have Chinese offtake partner Yawa, decide not to have any Chinese in their capital stack. However, Glencore, who they have a marketing arrangement with and participated in a convert, no doubt will be selling finished spodumene into the Middle Kingdom. because there are a few places else to sell it to other than, maybe a little bit in Tesla. So you want to talk, I have some views, but before I go into those, the comparator, right, is PLS signed a deal with Canmex with $1,000, price floor, and then Lithium Ionic did do a deal with Yawa just today with the same $1,000 price floor, which was not evident in the core deal, no price floors, and no discount and no ceiling, and a prepay. So what does this tell us about Western versus Chinese counterparties, for spodumene projects?
Well, I mean, I think the obvious is that at the moment, there's a fair amount of desperation in China to source spodumene. And, if you look at the Chinese sort of lithium market, I'm seeing a small deficit in lithium chemicals, but I'm seeing a huge deficit in lithium concentrate and lithium raw materials, not just caused by the lipid light shutdowns, but also caused by the huge growth in lithium chemicals production for the LFP value chain, which is translating, which is requiring more and more raw materials to come in. So I think there's an understanding of that from the Chinese converters, and an understanding that to lock these tonnages in, they're going to have to make reasonable offers. Price floors, take it with a pinch of salt. I think in an up market, price floor looks really good. In a down market, sort of have my doubts. We've obviously had situations before where Chinese companies have defaulted on price floors and on take or pay offtake agreements. So fingers crossed we won't have that sort of situation in the next couple of years. But I mean, it certainly shows the sort of, the need for raw materials and an understanding of that need for raw materials in the Chinese market, I think.
Rodney,
we always end up, this debate, and we had it last time in the down dip, Matt, where in the end, low-cost brines stood their ground and were the last man standing, which was SQM at $4,000 or $5,000 a ton. $1,000 spodumene, depending on what you use on conversion rates and grade and loss and so on and processing. That's kind of more, at least, on the $1,000 level, that puts you in the low, 10s, 11, $12,000, which is way above where brine can hold orders. So I agree, it's always a tough one when the price dips below that. But I'd like to think that we are moving towards where the cost curve, where it just there might be some marginal players, but where there isn't enough now with growing demand, that hopefully we're seeing that we aren't going to have that problem. Hopefully not in the next while, before we're slightly older men, because there's been so little capex that it should take some time to get everything back. Well, obviously the Zimbabwe can come back online, and so can lepidolite, but things grow in between then. And if YJ is correct, we shouldn't face this, that prospect, certainly this side of 2030.
I think one of the big issues that we've faced with the cost curve in lithium is because it's still such an immature market, there are actually relatively few producers. As you get more and more producers, obviously the cost curve has more and more elements to it. So the marginal cost of production encompasses fewer projects, if that makes sense. So, you wouldn't, fewer producers. So, you won't see, I don't think you'll see the stress on the whole industry, or certainly the hard rock part of the industry, in the same way in future downturns as we've seen it in previous downturns. I think when the industry is very small with just a couple of brine producers and 4 or 5 hard rock producers, you see a lot more stress on the industry than you will when there's sort of 20 or 30 or 40 or 50 producers.
I guess the other thing is, Matt, is clearly there've been some historical discoveries, but we've seen so little in the exploration space and so on. You aren't seeing a lot of huge new, other than Q2, maybe 1 or 2 others. You're not seeing all of these discoveries popping up where they are 100 million plus ton deposits.
Well, it's interesting you should say that because there are actually a few projects in Quebec that are sort of coming out that are look like being sort of 100 million tons plus, and there's some interesting grassroots stuff going on in Africa, which could potentially be interesting as well. But increasingly, it's not just enough to be 100 million tons. You've got to be 100 million tons close to infrastructure as well, or close to the demand base. So there, it's going to be very differentiated going forward. It becomes, I've sort of steered clear of this analogy, but I'm starting to get closer to it now. It becomes much more like iron ore in terms of, you've got to be closer to the infrastructure. And then the only way to get around that is going to be if lithium sulfate takes off. So if lithium sulfate takes off as a key intermediate material, then potentially you can get away from this need of being close to infrastructure. Because if you're
does that work though, ex-China though, Matt, lithium sulfate?
Well, if people put in assets that are able to utilize lithium sulfate in Europe or the US or North America. So, if you've got assets, refinery assets that can process lithium sulfate, then yes, very viably. But at the moment, it just so happens that all the assets that can process lithium sulfate are in China.
And then just as a commentary, you mentioned it, Howard sort of raised it in terms of the offtake agreement signed by Lithium-ionic. Are we seeing any meaningful progress in ex-China conversion facilities?
Well, it's a bit mixed, as we all know. Certainly,
and by mixed, do you mean no?
Well, certainly the Wesfarmers SQM facility seems to be making relatively good progress. The latest data I've seen, i.e. exports from Australia to Korea, there haven't been any in the last 5 months. So I take it from that the POSCO refinery may not be operating at the moment. Obviously, we've seen Albemarle idle their refinery. The Tianqi IGO operation is producing, but at very high cost. And we don't really know what's going on with the Tesla refinery. There's no real detail on that. So it's mixed. I think the really interesting one is going to be the Wesfarmers SQM. And the numbers seem to be improving. So if they continue to improve over the next couple of quarters, I would say that's a positive takeaway. But obviously with the caveat that we don't have the cost data for that asset. So we don't really know. Even if the production is rising, we don't know how profitable it is.
So Matt, let's look at it from a numbers perspective. If you look at what lithium supply will be this year and next year, bearing in mind that, although I haven't checked, in terms of the European passport and how much is domestically made and all of those things.
Not going to happen.
So now, okay. So this is my question then is, is it still China running riot, exporting to everywhere?
To tell you the truth, China is not a big exporter of lithium chemicals. China is using the bulk of
No,
its.
I mean, sorry, I mean as in EVs and then just sending them out. So the rest of the chain doesn't matter because you're getting a completed car pitching up at the port.
I mean, I think that China is going to continue to dominate in the rest of the world. So Chinese manufactured EVs being shipped to the rest of the world. We obviously, have seen a big increase in Chinese EVs going into the EU. There's a really interesting article recently that was flagging that I think something like 40% of China's exports to the EU are actually European companies producing in China and exporting to the EU, not necessarily Chinese companies exporting to the EU. So I think, that's a very important takeaway. I think for certainly for the next year or so, I think Chinese production and exports is going to be the key mechanism. Maybe it changes over time, but realistically, that's where we are for now, I think.
If I could like to just a further comment on one thing, you talked about the price floors and that the market's more mature with more players, Matt. I think the core financing is notable for that maturity. So here you have Glencore, which we've seen in press releases before, I think with Galan, but never did a deal. Albemarle did that $350 million prepay, which they never disclosed that it was Glencore, but we hear that it was Glencore. But here is the first time I think I've seen Glencore tied to a formal done deal, with financing provided. It is a marketing agreement, though, that not an offtake agreement, and they participated in a convert. If you look at the terms of that convert, Glencore was a small piece of it, but another player, a group called Infravia, which is like a French real estate, and real assets developer. It's a brand new name, right? But the fact that they kind of came in to fund a spodumene, shows the maturity of the market, right? That there are new alternative kind of private equity players coming in. And then you have Nabari, guys in New York who I've known for quite some time. They're ex-Glencore traders, actually, who have done, secured lending, for gold companies. I think they've been in business for 5 or 8 years. And we've shown lithium deals into them for, 10 years. They finally, did one, in a similar way that Appian actually did a royalty deal with Lithium Ionic after looking at lithium for 10 years. So what I'm saying is that lithium has matured. Conventional Western private equity players are coming into the space. But when you think about that, right, like, Chinese may renege on price floors. At the same time, they're taking the material. They need the material. That's real offtake. In the case of Core, you have a bunch of financial players in the capital structure. And if you look at that convert, the interest rate's relatively high. The conversion premium is only like 15%. Typically, you see a convert, it's like 35%. And then the Nabari loan was like at 9%. That's lower than when Namaska got 13.5% from, some hedge funds in New York, but 9%, for just a regular spodumene brownfield seems still relatively high. So it's not a cheap financing. And then they had to do the equity component. The equity component was done only at a 4% discount, which is quite low. And Core's valuation is like $500-600 million, right? Meaningfully higher than Lithium Ionics and Atlantic. Because I'm looking at this, and I mentioned it at the outset of this, there could be a re-rate opportunity or a market disconnect. There's Brazil risk, versus Ghana risk. There's also permitting risk in Lithium Ionics still. So it's not exactly like for like, but there's a lot of options there. Like, why did Core pick Western, and not go China? Like, is it a geopolitical thing? But Canmex and Pilbara did a deal. So it's not completely off limits for them to do that. So it's just interesting. There's maturity in the market. It's good for Core. It's good for spodumene players. But I think it'll be just interesting to see how other partnering comes, deals evolve, China versus ex-China and what the cost of capital is. I think it was easier for Core to do a deal like this because their equity was quite a bit higher, right? Any thoughts on any of that?
Well, I mean, I think we'll have to see what the cost of debt and potentially the cost of equity does over the next couple of years, because if we are moving into a higher inflation period, we may see them rising. So we may look back on this deal and say, actually, that was quite a reasonable deal at the end of things. But yeah, I mean, certainly for now, current environment, some of the, the Western cost of capital is much higher. So the cost of capital with Western counterparties seems to be much higher. And some of the sort of, offtake offers that I've seen from Western entities are less competitive than what the Chinese are offering. So will the Western entities sort of, lower their offering to be more competitive with China? Or what will happen? I don't really have a view. We'll just have to see how it develops, I guess.
Matt, I mean, look at private equity at the moment, globally or certainly in the West, is under quite severe pressure. So liquidity is definitely tightening. A number of well-known funds have shut their doors and are not letting money out. So I think everything is likely to be repriced upwards, especially. I don't know how liquid the curves are, to be honest. I haven't been watching the futures curves as closely, but I still don't think you can hedge out. So it is kind of equity risk to fund.
Yeah. I mean, I think it's going to be very interesting to see how it goes. But I kind of feel that the conditions were improving as the industry matured, but obviously, the specific sort of risk environment at the moment perhaps mitigated against a great deal.
I think the Core deal is good and interesting, and their valuation is decent. Who knows where lithium prices will be? But they could be very, profitable. To your point, I think, Rodney, or one way of looking at that convertible deal is, it's equity masquerading as debt.
Look, I mean, I've met with the Core management. They're solid guys. They're smart guys. You know them.
Absolutely.
James was previously at a hedge fund. I mean, he knows the stuff. I think they will have negotiated hard in a market. Their timing is good.
Yeah, I think Morgan Stanley was handling their process, and I think a BMO has been handling Lithium Ionics process. So anyhow, it's good to know deals are getting done. Processes are, there are lots of called off processes in the past when markets, were not so good. And Rodney, you were mentioning, other than Q2, there's not that many, discoveries out there, and that's because there hasn't been that much exploration. But as markets are improving, I think, Matt, you were alluding to, Lithium Africa's, for example, with Tom Benson, from Lithium Americas and Tyron, as an underexplored area. They just closed the financing. I think they have 12 million bucks. They're partnered with Ganfeng. We could see proper, and it's good news that, from Atlantic Lithium, Ghana, another African story. I think from an equity market point of view, there's not that many Africa plays, and it's underexplored. I think you'll see some discoveries there. And I think you were alluding to, Matt, there are some private stories out there in Quebec that we were in touch with that you'll probably be hearing more about from us soon, doing some pre-IPO, capital raising. We feel there are a couple of, uncovered stories not yet known to the market in other areas.
Look, I think Howard's is right. Africa offers a slightly different route. In the end, you've still got to get route to port and so on, and you do need to do the exploration and development. In Canada, there are some great deposits and potential deposits, but you still got to go through drilling season when you can and can't drill, getting to, put out a mineral resource estimate and then a feasibility and. So there's time. It's really the time window, I guess, I'm thinking about here. Africa can be expedited a bit quicker, but we've been through a lot. I mean, do you remember, Howard, I think from 2023, we've seen the tumbleweed come through the industry. It's been a long road. So
I mean,
we've had 3 years of tough.
We've seen it on the funding raised for sort of exploration, that it's been very, very low for the last sort of 2.5 years or so. And now we're starting to sort of see that in the industry. So we've got, the projects that were left over from the last cycle that, management has been able to push along a little bit slowly. But then we've got a lack of new projects to come on for the next cycle. I don't know what you call them, 5th generation, 6th generation projects. That's what we're really lacking. So, there are a few sort of exploration companies out there, but nowhere near as many exploration companies as there were in sort of 2021, 2022. And we need to start seeing, some large scale exploration.
But let's be honest, Matt, there's a lot of commodities to chase now.
Yeah.
When we've had previous lithium bulls, it's been lithium and everything else been a wasteland. Now suddenly there's a million things to chase, and lithium's kind of one of 5 or 6 or more. So there's copper, there's everything on the go. So let's see how long it takes.
One of our consultancy clients was asking me to sort of have a look at our supply demand model and do some work in terms of what incremental projects we thought could come on, because obviously if you look at our best forecasts out till 2035, 2040, we were very, very positive on best demand, and they were like, well, how are you going to supply the lithium for that? So can you go in and do a project in terms of incremental supply and how much supply you think can come on? And I did that project, and it was tight, but it was possible. But obviously that relies on, those assets coming into production sort of early 2030s. And if they get delayed, then there could be a very substantial gap.
So I do think that the diluting of exploration money across far more sectors is going to cause a delay here. So let's see how we go.
Okay, and on that note, you're essentially saying that good quality exploration stories in lithium are exceptionally scarce. And that is a perfect segue into our interview with Alicia and Neil at Q2. So I'll end it there. Rodney, Matt, thank you. And stay tuned to all our viewers or listeners for the next 7 or 8 minutes update on the press release that Q2 put out earlier this week. From Alicia Milne and Neil McCallum at Q2, who put out a press release earlier this week. So Alicia, tell us what happened here.
Yeah, I mean, it was a good press release. We issued some visual results from some holes that we had drilled over this winter season. And we also announced just a slight delay to our MRE that we were planning to publish by the end of this month. So it's only delayed for a few weeks. And Neil can speak more to why exactly we're delaying it. But yeah, it's all positive things.
Okay, so you had told the market that you would by the end of Q1, you would have your maiden resource. So on March 23rd, 8 days before the end, you realized that wasn't going to be ready. So you put out a release that'll be slightly delayed with some other information. I guess that's the message. And okay, so yeah, Neil, let us know.
Yeah, of course. Really, the results that we included in that release of the visuals kind of tells the story of why we would want to, given that several of those zones are outside of what we had previously known. A few good surprises in a way that outline additional areas that won't have assays, but they'll be expanding some areas of the mineral resource estimate, plus allowing some additional tonnage for the exploration target. So we felt like that was important to include in the upcoming MRE rather than, having that cut off in that December timeframe included a bit
just
more.
to confirm, you won't have the assays for these results to include in the MRE. It's just to sort of show sort of what's possible.
Yeah, exactly. Some of the, the modeling will push out areas. So some assays from other holes can be estimated in those areas. Yeah.
So getting into the nitty-gritty of how, well, without getting into the nitty-gritty maybe of how resource estimates are calculated, they're calculated sort of using sort of like probabilities and geostatistical work. So by showing that there's mineralization in other areas, you allow the person or the machine that's calculating the resource to factor that in. Is that correct?
Yeah, that's a really simplified, nice way of putting it, for sure. Yeah. And then in those areas where the calculations won't spread it far enough, that's going to go to the exploration target category because it won't have as much certainty or as much data towards it, but it's going to add to the overall understanding of just how large it is.
Okay.
So your MRE is going to include a additional new exploration target.
Yeah, that's the idea. Just so that it's possible there might be some areas that are kind of outside of our actual estimated area given the assays and given some other parameters. It sort of highlights what we could know because it's going to be the first MRE and there's going to be some areas to grow given that it's a fairly new project, only 2 years. So that exploration target sort of allows for that upside potential that I think is really valuable to demonstrate here.
I mean, as we've discussed before, I think that you outlined some pretty significant exploration upside outside the current sort of exploration target zone.
Oh, sure. Yeah. Well, those are sort of like earlier stage things that we still need to drill, still need to test that we haven't done yet because we've been focusing mostly on infill. So that's a whole other exploration upside that is really hard to quantify. But it's something that we'll be putting a lot more attention to this summer.
And can I confirm, just from the drilling you've done so far, what sort of depth you're going down to on the current MRE?
Yeah, so the MRE will include estimations as far down as the pit shell goes. So that's sort of like, in a mining scenario, let's take this pit down a certain degree. We haven't figured that part out yet. That's kind of in the works on the MRE calculation side. So that'll be published when we come out. But in terms of what we've drilled, it's going down vertically 500-600 meters in some areas anyways, where we end in mineralization. It just keeps going in some regions.
Okay, interesting. So there is potential at depth because obviously there's a number of projects that have gone from open pit to underground or directly to underground. So there is the potential underneath the existing pit shell.
Exactly. Yeah.
Okay.
So Alicia, Neil, could you just remind our viewers what your exploration target was that the market was waiting to see the net result of?
Yeah, for sure. It was based on the first 40 holes drilled for 16,000 odd meters, and it was estimating 215 million tons to 329 million tons at assaying at between 1 to 1.38% lithium oxide.
Okay, great. So I was just kind of looking at the stock chart. We saw you at PDAC. It was the day 1 of the now day 25 of this Iran war, and your stock had hit like 271. I see it's now trading at 197, about 27% off its high. A lot of things have got hit because of the Mideast event, but when I saw that press release, I thought that this might be delayed for and would be incorporating all the new information that you put out in that press release. So it might be multiple months before that, and you are again at the beginning of this kind of like Lassonde curve. There's a big market expectation for will you hit that exploration target, but you've clarified basically that there's new zones here. There'll be a new exploration target in combination with your MRE, and stay tuned for those hoping it would happen by March 31st, it looks like you just have to wait a few more weeks, as Alicia said, not months. So very much look forward to that. And for those who, my overall view, in this market turmoil is that, certain commodities are getting shaken out and certain stocks are getting shaken out. But there will be a resolution, I hope, in the Middle East. And when people kind of come back and it's risk on again, they're going to migrate to the commodities and then the companies that are of the highest quality. And lithium, we're feeling quite optimistic about. And, the Pilbaras and the big producers are one thing, but when it comes to the earlier stage stories, Q2, as we've described before, the hottest, spodumene exploration story, at present and possibly ever in the industry, definitely meets that definition of high quality. I'm biased. We're biased. We're advisors and shareholders, of Q2. So this is not advice, but the stock's 27% off its highs because of the war and perhaps yesterday's press release. So bear that in mind. And thanks again, Alicia and Neil, for interrupting or taking the opportunity to have the market understand what was behind that press release in a bit more detail.
Perfect. Thank you, Howard. Matt, appreciate it.
Thanks.
Okay, great.